And good afternoon, financial professionals. My name is John Florence, and I am the Senior Vice President of Marketing here at E4 Insurance Services, welcoming you once again to The Brew, where we build relationships every week. Thanks for tuning in to us today. For those of you joining us for the first time, welcome. On today's Brew, we welcome back Nick Natzke from M3 Financial Services. We've been working with Nick for a long time. And Nick is a financial advisor that's been in the business for a number of years, and he's going to share some ideas that he's been using in his practice for fixed income alternatives. Before we get started into that, I'd like to remind you to please feel free to use the chat box to share any of your thoughts or ask any questions. Also, all attendees are in a drawing for a continuing education voucher and a Starbucks gift card, where you can get a coffee milkshake. And we will be announcing today's winner at the end of the program. So while we get everybody settled into their seats, welcome, Nick. It's great to see you again. I think the last time we saw each other was back in May at our BBT event in Delafield. And so before you get started and sharing your ideas, tell us a little bit about who you are and how you come to be in the business and what it is that you do.
Yeah, great. Thanks, John. Appreciate it. So been in the insurance financial industry for 20 years now, and help people out, obviously, with navigating retirement investments strategy. Like to think of myself as a strategist for my clients to help develop their plan that carries them forward from now until end of life, as well as looking at how do we pass, money on to the estate or heirs or what have you. So today wanted to talk about a few things. So some of the things that have been going on with the stock market, with the interest rate environment, with inflation, all of the different things that we have, going on right now, and not to go, completely macro and but just talk a little bit about how I've been positioning clients based on what's been going on with the interest rate environment. So a few questions that I'd pose to you today is, do we know what the interest rate environment is going to be in the future? No. Do we know, what will the Fed do in the coming days? Obviously, as of recent news, the inflationary data has come down, which is, positive thing. However, do we know, do we have an idea of exactly what the Fed is going to do? We don't. There's a potential they may hold the line. There's also a potential that they may increase interest rates. And so what do we do? How do we navigate, some of those curves? A lot of clients recently have been coming to me looking for some stable income, wanting income preservation, not losing. They're worried about the market. They've seen, their accounts go from, high water mark to, lower in a pretty quick fashion, and a lot of people, taking that gasp. There's been a lot of pressure on stocks. There's been a lot of pressure on bonds, and in the lower interest rate environment, that's kind of expected. So what do we do? What are some options? So I will say this: I don't feel that there's any silver bullet that's going to completely, solve every concern, right? You have inflationary risk concern, you have interest rate concern, you have stock market concern, you have the bond market concern. I don't feel that there is one product that's going to be able to, satisfy all of those needs in the silver bullet. And so looking at that, meeting with clients, understanding their goals, objectives, risk tolerance, investment time horizon, all of the things that we do as financial professionals to help navigate and guide our clients is taken into consideration. And so when you think about this is just to give an idea, not to give recommendations, but just to give an idea of some strategies that you may incorporate to help those clients get to retirement success. So at the end of the day, this is not my money, it's my client's money. And my job is to really, truly listen to their goals and objectives and put together that strategy based on the information we have now today, and navigate in the future. So when I look at this, I always look at it as people with options are way happier than people without. And so when I look at crafting a plan and a strategy for somebody, I really take that into consideration. So we want to be able to give predictability, certainty, and then come up with that solution that fits their needs. So one of the things that I've been incorporating is, instead of utilizing bonds inside of a investment portfolio, let's use the $1 million example as a example here. Client has $1 million, and we could, maybe they're a 5 on a 1 to 10 scale, right? So 10 being risky, 1 being conservative, they're a 5. And so we might position that individual as like 50% stocks, 50% cash and bonds. And instead of utilizing the bonds portion of the portfolio, which, by the way, if you look at the recent data, maybe hasn't performed as good as what it has in the past. And one of the reasons is because we've been in this rising interest rate environment. So by using a fixed annuity, we can eliminate some of that interest rate risk on the short term in the last couple of years, as we've been in that rising interest rate environment, because that has been stable, right? We haven't lost any of our principal, and we've got a guaranteed rate of return. Obviously, rates are subject to change. And so, right now, for 5 years, depending on how much money the client is willing to defer, you can get anywhere from, 5.25%, in the 5 year, maybe 5.4% on a 7 year. Is in that scenario, that $1 million scenario, instead of using a traditional 50-50 investment portfolio, carving 50% of it out and utilizing that the interest rate as preservation of capital, as well as interest. So if you have a client that does $500,000 and defers it for 7 years, right now they're going to get 5.4%, and they can take that money, which is $27,000 a year, and just utilize it as income. At the end of the 7 years, they still have their $500,000 principal, so that was protected, and they've had the income to live on along the way. So it could be a strategy that you utilize for clients that their objectives would be, preservation of capital as well as secure income sources. And then let me finish that out before I go talk about the other option or the other idea. The other 500,000 is maybe allocated at like a 98% equities portion, where between the two accounts they're really still coming out as a 5, and they understand that half of their money has no market risk, the other half has the other risk. And going back to my comment about silver bullet, right, is that if you put everything in the market, you can't eliminate market risk. By utilizing some portion in a fixed annuity, it eliminates that market risk, right? And so we have some sort of guarantee protection, principal protection, as well as guaranteed rate. So again, going back to that silver bullet comment, there isn't a product out there that is going to satisfy every single need, in my opinion. And so it allows choice and option. You'd obviously have to re-review this. The client would have to understand that they are giving up, that money for that period of time. But in that scenario, they're running 5.4%. That's a pretty healthy interest rate from what we've seen in the past. And we still preserve capital inside their account.
Hey, Nick, look, can I ask a question here? So I think that's a really great idea. But going back to your client, normally they would have taken that half of their portfolio and put it into, say, some sort of a bond portfolio or bond ladder. What's the downside of doing that? Because bonds are traditionally considered to be very safe as well, aren't they? Or,
right.
So where's the trade-off here?
Yep. So, however, bonds are not guaranteed, right? So you have a client who says, I want to be able to sleep at night. I want my plan in place. I want it intact, and I want to be able to sleep at night. I don't want to watch my bonds go down 2, 3, 4, 5, 6, 7%, right, in the short term.
Right. And as interest rates are going up, the values of those bond portfolios are declining. This just happens with that inverse relationship.
Right. Correct.
Excellent. Well, that's a great idea. What other ideas are you sharing with your clients who are looking for these kinds of safe growth opportunities?
Yeah. So that's kind of a hybrid model that I've been utilizing as of recent. Again, because of the high interest rate, the guaranteed principal protection, and just giving choice and option. And that way, if they decided to do a 5-year fixed annuity, a 6-year, 7-year, they are re-evaluating that plan with you, at the 5-year mark, right? So they do have to understand that it's not a lifetime. And I like that personally because I'm always looking at this as choice and options and not doing a box, right? I don't like to use a box with the client. I don't think it does them any favors or us any favors, trying to help them navigate through the rest of their life. So the other is a fixed indexed annuity, and those now, depending on the age, depending on the carrier, depending on the client, there are a lot of asterisks here, small print, so don't take this for exact science here. But if those had, for example, a 7% distribution rate, that's obviously higher than the 5.4. The downside is that money is kind of allocated right towards that fixed index sleeve, and it may grow, it may not, but it's kind of indexed towards that that index sleeve. So I look at it more along the line, if we did do a carve out for something like that, that money, I'm planning that it's kind of allocated and spent and not coming back into the picture. However, if they can get like a 7.25, 7.5, 8% distribution rate on those dollars, depending on their age, something to also consider. So if that same $1 million scenario, right, work with your with your planning software, work with your E4 sales director to help devise the plan and strategy to come up with the proper amount backing into it, right? If the client needs $5,000 a month of income, backing into that to allow flexibility, but also utilizing that product. And the reason why is, and I don't know if you can share the screen, John, or if I can. Maybe I can share this. Maybe I can do it this way. Here we go.
You got it? Okay, I was going to say I can do it otherwise, but it looks like
And this is a piece from E4. What does it take to guarantee $2,500 a month income for life? Well, at 65 in a 60-40 portfolio, if your assumption is a 4% withdrawal rate, it's going to take $750,000, right? If we did an income now option, right, we've got I'm going to round it, $407,000 to get the equivalent. And obviously, if we started planning in the future, we have $266,000 now. And so that being said, if you're right at the retirement red zone with your client and they're going to retire in the next 3 months, this would be obviously, you have all the things that you have to complete as a fiduciary to review if this makes sense or not. We're not making any recommendations, just education today. But looking at this, you have, if you had that same, client, $1 million, well, they're going to have to allocate $750 to make sure that works at a 4% withdrawal rate in that 60-40 portfolio, versus if we carved out $407,000 and left them, $593,000 to go towards their discretionary, right? So this is more of their paycheck bucket, right? Paying for gas and water and utilities and internet and food and groceries and whatever, and then the remainder can be utilized as the fun bucket, the play check. So the going to the golf club, the yacht club, the Tahiti, Hawaii, Florida, what have you. So it allows that flexibility, it gives options, and it gives predictability, guaranteed income, while allowing for potential growth in the market with the other $500,000. So it goes back to strategy, plan, options, and what tools, resources do you deploy with your clients to get them to where they want to based on goals and objectives. And I will, leave in saying that there's not a silver bullet. There's not any one product that is going to fit every single client need. And so it goes back to learning what that client wants, what they need, allowing them options and flexibility now, and for in the future. So.
Thanks. Thank you very much for sharing that, Nick. I think it's interesting, you showing on that chart there, the difference between 750,000 that you'd need now to get that guarantee versus the 406. It's pretty substantial.
Right.
As we calculated out, about 45% discount, if you will, to buy the same paycheck. The difference being that your paycheck with the annuity is guaranteed, whereas your withdrawal from a systematic withdrawal from a portfolio is not guaranteed at all. So
Right.
it seems to be a great advantage. But isn't that also, you talk about these as being indexed annuities, aren't they dependent on what is going on in the market for their performance?
Well, so yes and no.
Okay.
Right. So there's a potential for growth, but it depends, right? So if their growth is 8-9% and your distribution rate 7%, right? Well, then that's a positive thing. But the best thing that I feel about these products is that you do get that guarantee for life with a potential upswing, right? And so when I look at it, and this is me, others may feel differently. When I look at it as there is a potential, but I'm really communicating it to the client that this is what we've got. Here's the guaranteed column. We know what we're going to get, potential, but I'm really sticking and focusing in on the guarantee. So yeah, good question, John. Thank you.
Fantastic ideas. Let's see if there are any other questions coming in from our listening audience. And while we're waiting to see that, I'm going to just remind everybody that today's brewcast that you're listening to right now, as well as our entire library of recorded brewcasts, are shared on the Brew blog at our website at www.e4.insurance. It's also available on our YouTube channel. You can just go to any browser and type in YouTube E4 Insurance, and you will see all of the videos of all the previous brewcasts that we've had. Also, while we're still waiting for some questions, we do our giveaway. So Nick, I'm going to ask you to please pick a number between 1 and 22.
I'll do 21 because that person probably came in right at 12:01. So I'll do 21.
21. Okay, very good. And let me see who we have. It looks like our winner today is Jack Watts. So Jack, congratulations on your win, and be on the lookout for the complimentary CE voucher and Starbucks gift card that'll be coming your way from all of us here at E4 Insurance Services. So I'm looking at a question from the audience about market risk. How do you feel market risk contributes or not? I'm not sure if maybe there's a better way to phrase that question. Does it contribute or not? Are you reading anything into that? Okay. The question comes back. Does the use of an indexed or a fixed annuity remove market risk from your client's portfolio?
I think it does, and the reason why is because it's going to give that guarantee, right? You have guaranteed income, and we're planning, right? Looking at the guaranteed column that this is what is guaranteed. So I do feel that it does eliminate market risk because you can't lose your income that's guaranteed for life.
Okay.
Yep.
Great. Thank you for the answer, and thank you as well for the question from the audience. Well, looking like there are not any other questions coming in, we'll go ahead and wrap this up. I want to thank you again, Nick, for being with us today and sharing those ideas. I think they're very useful, particularly in this time. I was noticing earlier, I saw an interesting statistic that the number of assets that are sitting in money market accounts in the United States has surpassed $5.4 trillion, which is the highest point since the beginning of the pandemic, and is certainly an enormous amount. And that's indicative, I think, of where clients' mindset is. There's so much uncertainty with what is going on in the markets right now, so much uncertainty with what's happening with interest rates and inflation, that when people get nervous, they're looking to sit out. And while that may seem like a great idea, there are better alternatives probably than sitting in money market accounts. And I think you've given us two really great ideas for that.
Right, correct. Yep. And so to piggyback on that, you could look at a bank CD I've noticed the banks have had a pretty seductive rate lately, but they don't, from what I've seen, I haven't seen them, guaranteeing, 5.5% for 6, 7, 8 years. It's, more on the short term. So that's nice to do it. If you have a client that just wants a short term, hey, I just want to, park this money for 6, 7 months, maybe a bank CD would be a good spot to go if they can get 5% interest. At 6 months that, annualize it's 2.5%. So, probably better than sitting in a money market. But yeah, if they have an opportunity and they're willing to defer that for, 2, 3, 4 years, and get a guaranteed rate that's, locked in, 4, 4.5, 5%, depending on the company carrier, it might make sense to do a non-qualified annuity. And they could either, with that non-qualified annuity, remember, they can cook and grow that, or they could also decide to take that and just live on the interest as well. They have that option depending on the carrier, right? But they do have that option as well. So,
and not to mention the tax deferred aspects of the annuity as well. Which you go into the CD, for every year that you're in there, you're going to be hit with a 1099 for whatever the gains that you had. And with the annuity, you kind of get that triple compounding effect of the tax deferral. So really, really great ideas. Thank you so much, Nick. And we look forward to having you back to share with us in the future.
Yeah, thank you.
Join us next week on The Brew as we will be inviting Brady Serold, E4's brand new Senior Vice President of Disability Income Solutions. And Brady is going to be kicking off this new division of our company starting next week and for the subsequent 3 weeks. We're going to really get a deep dive into what disability income insurance is all about. Why is E4 doing it? How do we present this to clients? What are the solutions that are available to you? So we hope that you'll join us then. Come back and see us next week here on The Brew.